Hi everyone, Mark here at TSLA, and as you can see on the screen, unfortunately Tesla closed down today again. $260.02 was the closing price, and that's a 1.1% drop, and that in dollar terms is $2.88 down. So as we kind of figured, when Tesla has a big crash or a drop in price, regardless if it's an event or otherwise, there is some momentum to the downside as far as the stock goes. It's just kind of the tendency for a lot of stocks. And there's kind of this 3-day rule where if something goes down, multiple percent due to earnings or what have you, you might want to stay out of it for a couple days, because what's happening is the market and a lot of investors are digesting like, okay, so number one, they want to get out because staying in has risks. There's this idea that if you need to be patient with the market, well, that's fine and all dandy. But if your time frame is very, very short because you're day trading or swing trading, you actually have to panic faster. Panicking faster is really the really best way to get yourself out of a really bad trade. And so a trade doesn't become an investment because, let's say you didn't sell at 270 yesterday, then now you're at 259 today. So that's what I mean when panicking sometimes is beneficial if your time frame is very, very short. Not financial advice though. But it sold off actually pretty strongly in the morning. If you were to, and this is the minute time frame, by the way, if you were to check out the opening price, which was around 268, and look at the low of the day, which is $255.81, it was a 4.5% drop. It's a huge swing. So what does that tell you? Is that people really want to get out. They just want out. Like, they use that gap up opportunity to just remove themselves from the situation. And, if you're selling at the open, not necessarily a bad idea because it closed below the opening price by, $8 a share. You would have saved yourself a lot of stress worrying about the intraday movements of the stock, even though it kind of got bought up. So we kind of drew a squiggly line yesterday, thinking how the stock price might move based off the number of options and where their strikes are at yesterday's close. Now, due to today being options expiration, where literally trillions of dollars worth of options and notional value are expiring today, there's a lot of kind of manipulation based off the idea of where the market makers want to put the price of certain equity or stock or ETFs and stuff like that, because they have a lot riding on this. They basically want to make as many options expire as possible. And with the day being a little bit red for some things, you could tell that more people were being biased on the short side, and there were more puts being put into the system, causing a lot of pressure to the downside for a lot of names, even indexes as well. But looking at the morning, so I figured there would be a drop in the morning. I didn't think there would be a huge gap up, but I figured that over the course of the morning, you would have a sell-off, and it sold off severely for a couple hours. And as traders went to lunch and their computer algorithms took over trading for them for a while, you were seeing some buying, and you actually got bought up pretty heavily, about to the peak around, the drop around 4.5%. So this was kind of this V-shaped recovery, you could say. And in my mind, it was going the way I thought it would go. It would be like, okay, so you would have this buy in the morning, a little consolidation, more buying again. And these consolidations are because it's hitting certain prices or really probably strikes and options. And they were really thinking, the market was really thinking how they should handle it. Should they show their hand early? And they never want to show their hand early. They actually want to wait until later on in the day before they show what strike price they want to pin the stock to. But if you notice, the top of the range here at anywhere from 11 to 12:30, this was the strike of $262.50, and it shot past up out of that flag, and guess where it stopped at the next strike, which is 265. This is not coincidence. This is basically either kind of baiting people to get their options orders in, and it'll be like, okay, if they want to pump up the stock in the morning, it's because they want to load up for puts in the afternoon. So the idea is to kind of get buy orders in big chunks to kind of entice other people to either, close out their shorts to send the stock price even further, or entice people that, okay, the stock is fine, it has interest, people are buying. Okay, we had a big sell-off yesterday. This is natural to have a little bit of recovery. And so they were trying to get more people to get their options orders in because today has so much eyes on the expiration, just because everything else, especially the SPX, there's a lot closing in the S&P 500. And so after it broke out from the 265 strike, it went on and went to the 267, and it almost got to the 267.50 and immediately sold off. And it sold off until there was this battle at the end of the day, not just in Tesla, but across the market, trying to pin all the different tickers at the prices that would put mostly the puts not in the money, and make those options expire worthless. But there is a very considerable fight for Tesla because it closed just 2 cents, okay? 2 cents, as you can see here, above 260. And the reason why that's very significant is during the course of the day, there was a kind of an evolution of the quote-unquote max pain for Tesla. Now, I thought the max pain, based off the options yesterday, or the number of options and their strikes yesterday, would be around here because it kind of coincided with a little consolidation and before the big sell-off yesterday. But yesterday there was a lot of calls around the 270 mark. So I was wondering, do they want to close above it or below it? Because I didn't know who owns those calls. So if the market makers aren't the ones who own those calls, or the people with big money don't own them, then they wouldn't be above the 270. It would be right below 270. Like something like a 268 price would be kind of interesting, where my cursor is right now. So it could have been, okay, we'll get up to 268 and kind of hold it here, not let any of the 270s get in the money, and also not let any of the puts at 265 or 260 get paid out. But it actually evolved relatively quickly, and I'll show a screenshot of, I took a screenshot of the various times during the course of the day, and how where the number of options that were being bought and where they're at as far as the strike goes. So I'll switch over to that now and we can take a look at that. So as you're seeing here on the top left hand corner, this was a screenshot that was taken around, I would say 11 o'clock in the morning, I think. Yep. And that was, as you can see, pay attention. I know it might be hard to see, but pay attention to the left hand side of each of these graphs, and you're seeing the volume of options being purchased, and the bottom part is the strike. And so there was, a lot of interest at the 270 early in the morning, and you're seeing that on the taller. So there's just 2 high green spikes. It's the one on the right hand side, and then you're also seeing develop a 265 and then 260 area. And but the big red spike is 260 as far as the puts go. And the number on the left-hand side shows that, 90,000 puts were purchased already. And the next screenshot of the graph would be over to the right, top right. And that was around 2 o'clock in the afternoon, Eastern time. And looking at the left-hand side, you can see now that the red spike at the 260 puts is over 200,000, like 220,000. And there was a lot of calls developing around the 265 and 270 area. But there's more. You're seeing more puts. Number one, probably because of hedging, and more people are not biased to the downside for the Nasdaq rebalance for any Nasdaq names, really. And moving down to the bottom left, and if you look at the left-hand side, you're seeing even more options are being bought. Now, I have to say the reason why it can evolve so quickly during the day, especially the day of expiration, which is Fridays for single tickers like Tesla, is that because there's just so much cheaper. Like if you were to buy a put at 260, which is the tip of the red spike, the 260 would have been super expensive just 2 days ago, but now they're you can get them for cents. And you're seeing that the number of puts at the 260 is getting close to 300,000. And this was taken around 3:45 in the afternoon. And the last screenshot on the bottom right is showing now that the number of puts is approaching 300 and 30,000. And the number of calls is also increasing as well, but being far outpaced by the puts. So as you can tell, if you were to use this maximum pain site or use your options chain kind of tracker, or if your brokerage offers you some type of service like that, the fight's going to happen either at the call tip or the red tip for the puts. It's basically saying like who has the most money to affect the price before the close. And they're going to fight for this close really right to the last second of the day, because it's you don't, like I said, you don't want to show your hand, and that's why you see volumes tick up in the last minute or so severely, just because, like, why show it earlier and then have to spend more money to try to affect the price even more so. So this is why the max pain shifted from what it was yesterday, could have been around 270, to what it was easily 260 now, and it's just so much more obvious. And that's one of the reasons why the stock dropped, because at the 265 point, let's say if you're looking at the top left hand chart again, which was like around 11 something a.m., and during the course of the like kind of lunchtime in Wall Street, Tesla's approaching 265. And that's a lot of calls in the money. And Wall Street was not going to pay any of that. And they basically sold it off. But they realized that there was a lot of puts piling up at 260. So they kind of had to like taper their selling, have it sell off over the course of the day very, very slowly. And at the very last second, close 2 cents above the highest number of basically the strike price that has the highest interest and the highest volume, which was of course 260 even. So I was actually watching that with bated breath. I was like, okay, so I get it. They're gonna fight around the 260 mark, but who's gonna get it? And the puts all lost because there's too many puts. If the calls would have outweighed the puts easily, this would have closed at 259 and like 98 cents instead. But that wasn't the case. So if you ever are on a day trading, that's a Friday or an OpEx day, number one, I kind of suggest staying out sometimes. Though there were some really good intraday movements, you would have to be very, very quick. You'd have to be basically day trading on a daily basis to understand. Like if you're watching the S&P 500, it got to certain points where it was equaling its high during the course of the day, and it would just sell off immediately over and over again. And so if you're scalping, meaning just getting in and out really quickly with the options, it would have been a decent trading day. Some of the puts that I was buying, they just weren't really moving all that much because the volatility was dropping severely. So even though a lot of stuff was red, mostly tech stocks, the volatility was just being destroyed. And it seems like every Friday, volatility gets crushed. So sometimes the options don't really move in the way you think as far as the value that they generate when you get the direction right. So sometimes it's not even worth it to scalp very small moves when the VIX is just crushing itself, because like the risk is just not worth the reward at certain times, unless you're just very confident with the chart. So let's go back to the chart saying that. So we're back at Tesla, and there's been a lot of talk about the NASDAQ rebalance, and we don't really understand, because it is a special rebalance, meaning it's not a typical rebalance. This is something they're doing just because they felt like they really needed to do something about the overweighting of just a handful of stocks. Unfortunately, Tesla's included with that. Now, when the rebalance came out, it was news a couple of weeks ago, right? And they are talking about, and I showed you the weights in yesterday's video, and the weights was Tesla was at something like 4.6, 4.7%, I think. But the problem with that weighting is that all those weights were determined early in July. And as we know now, Tesla has sold off severely. So it's obvious that Tesla wouldn't be the same weight as it would have been earlier in this month, unfortunately. But the reweighting of Tesla has already happened. It's going to be reduced by some 1%, almost 1%, and that's being done when Tesla's stock's price has dropped severely, and that the weight of Tesla is much lower than it was even just 1 week ago. So it's kind of like a double whammy for Tesla, where it's being sold off because of its earnings reaction. It's being sold off today because of OpEx, and then it's also being sold due to the rebalance. Now, the after hours action was really unfortunate, and so I just turned on the extended trading hours graphing here, and you can see that there was a really big sell-off for Tesla after hours. And if we were to measure that, it was from its closing price of 260, it went down almost to $3.50 lower. And so I think at the lowest I saw was like 56.98 or something like that. And it closed after hours at 258.70. So it got bought up just a little bit. But you kind of wonder, like, there was no real news that came out. And the reason for that is because due to the OpEx, if people were wanting to get out, maybe they didn't want to get out during the actual regular trading hours. It was the regular trading hours were quite manipulated to achieve that maximum pain. But let's say you're sitting there and you're a fund or big money, and you're like, you know what? We haven't really experienced what a NASDAQ rebalance would really look like, and it comes into effect Monday. And you would say to yourself, look, is there going to be more selling on Monday? And you couldn't maybe sell everything you wanted to during the course of the trading day as you tried to maintain your max pain. So either that this was some type of desperate insider selling, or this was just people naturally wanting to get out. And that would be people that, not like you and me, but bigger money, fund money, institutional money. They were just wanting to de-risk before what could be a very bad week for tech next week. Because, if you thought Tesla and Netflix reporting this week really, really affected the QQQ, let's say, well, think about next week when we have Microsoft and Google reporting on Tuesday. That could be, if they don't report very well, it could be devastating for the NASDAQ. So I think it's a part of a de-risk. It's partly because people really want to get out of Tesla, and they maybe really didn't get out enough today. Or this was like some type of like quote unquote insider selling or something. But it's really inexplicable. There was no real breaking news that really caused a sell-off. Let me overlay Netflix, because Netflix kind of sold off after hours too. And Netflix would have been kind of in the same boat with us. It's like, the reaction of the stock's earning really wasn't that great. And it sold off today just like Tesla did as well. And during the after hours, it also sold off the entire time, where Tesla kind of sold off more severely and had a little bounce. But I really think this is because there's an unknown quantity when it comes to the rebalance. There's also an unknown quality when it comes to even just the margins in the company. I think people really, really want to get out. So, they don't have to bear the burden of what could be a very long consolidation for Tesla until there's clarity on what this company is really, making, the revenue and profits, what they're really, really making. If you want to zoom out, and I'll turn off the extended trading hours, we can take a look at Tesla's consolidations again. So I took out the areas where I highlighted the consolidations, but just kind of a word of warning: when Tesla gets into might be what might be a topping formation, it will proceed to sell off more and more as time goes on. So let's draw rectangles around the consolidations that we've noticed before, and we can start to understand that if there is still this kind of de-risking, if there's a negative sentiment towards Tesla, I wouldn't be surprised to find more selling pressure eventually if the rest of the tech sector is not all that strong. And so we're seeing here that we're still within our range. Like, we still haven't broken down below the 245. But how far is that really? What is that? Or maybe $15 a share to touch the bottom of that quote unquote range. We filled a lot of gaps in the local area, but there's still a big one here at 236. So if we're looking at the consolidations again, there's no convincing catalyst for Tesla to go up. Now, You could say that, the market is not understanding. Like, there's a good beat on EPS. They had they still had positive free cash flow, and the margins only dropped by 1% quarter over quarter. We don't know if that's the bottom, though, is the problem, and we won't know. And guess what? Until the next quarter. Could you see any reason for Tesla to be bought up? And if there's no real solid reason, maybe you and me, maybe retail investors, individuals are very, very bullish on the fact that, look, Tesla is, they're the leader in the sector. People are reaching out to them for their full self-driving software. And that could be a software like margin for Tesla on a product instead of the 18 to 19% gross auto margin on their physical cars. And physical goods don't necessarily will have the best. Well, it's really just cars don't really have great margin. A lot of physical goods do, like, iPhones and what have you. But getting to the point where the company shifts its focus towards providing services and software, then you could see a margin expansion overall for the company. But these are all unknowns. So if they're all unknowns, you're not getting any guidance that the stock is, the margins have bottomed. Why would you buy it now? And saying that, I'm not saying to go short. I am a little bit short, just because I find there's very little story to sell on Tesla unless all of tech beats next week. Then maybe that people will be comfortable with the AI story that Tesla's presenting. They're comfortable with the fact that margins have bottomed, and maybe the economy is going to have a nice boost if there's a very dovish speech at next week's federal FOMC meeting. So that's something to look forward to as well. Next week's going to be action-packed with Microsoft reporting, Google reporting, energy giants reporting. It's going to be basically a very busy earnings season next week, along with FOMC on Wednesday and the inflation report on Friday as well. So there's a lot going on that will keep Tesla further consolidated in a range, or even a little bit to the downside. I would not be incredibly surprised to find more selling pressure on Monday, unless there's some type of news that Elon's going to break or something. A sentiment boost would be nice. I would say a sentiment boost would be another opportunity to maybe sell calls. That's not financial advice. Something I would do, just because looking at this chart, when the ranges occur, okay, there's always a move after them. Now, we've only been in a range for, how long has this been range for? Let's measure it. So this range is relatively shorter than some other ones. So far, it's been 46 days. So yeah, that sounds like a long time. Let's measure out the other one so you can kind of get a good idea of how long Tesla can range for. So this is 69 days. So I would say over 2 months is basically what Tesla's been doing over the course of the last 2 years. It just has very unconvinced investors, I guess, because after the move is done, and you can see here like a sell-off here in September, it'll try to catch itself. So if next Monday, Tuesday, and Wednesday turns into a flag, or the whole week turns into a flag that kind of looks like, let's take a look at the selling from the Twitter purchase. If you see this, so there's a big drop from 312, and you go down to, you drop 8.5% over the course of some hours of trading, and then the next day you drop again. It's a gap down, and you see a low of another 6%. And it creates this pattern where it's what people would call kind of like a bear flag, where it comes off a sharp sell-off, which turns into a pull in the pole of the flag. So that's just textbook. That's a textbook bear flag. And now let's look at today's action. And I'll go ahead and delete our little squiggly line drawing. It's no longer relevant. So what can we expect? If you can convince yourself, okay, that Tesla has answered all the questions about its fundamentals with this earnings report, then you can maybe say this is going to be like a V-shaped recovery where you just have up and it just goes up. Or you can say to yourself, they're not really convincing and getting a lot of buying here. I mean, looking at this is the hourly, and looking at the indicators, you could say maybe, yeah, the RSI shows really, really oversold. The stochastic is showing a little bit of buying, but with 3 red candles close the day. And the MACD is just desperately bad in a way that hasn't been seen in many weeks or months, really. It's not since the end of last year has this looked that bad. So some of the indicators are showing that maybe this is the bottom. But the reality is I just don't have the comfort of, as an investor, I don't necessarily worry, but as other people who are institutional investors or fund managers or people running pension funds or whatever they're doing, like I really doubt they found comfort in the story that Elon was pitching, and especially during the earnings call. Those type of earnings calls that Elon is doing is for people like you and me, individual investors, where we like to hear cool stuff about robots and AI, but those are not making any money right now. But what they really wanted to hear was a very vanilla type of earnings report saying, look, we make cars and the car margin is bottoming out. We foresee margin expanding by 2 quarters from now. And I think if they would have said something like that, then I would have not been necessarily surprised if the stock at least stayed flat over the course of 2 days. But what would a bear flag look like? If you look at the September flag, it traded, let's measure it so we can see how long it traded before it sold off. So it was a period of 1 week. 1 week. So if the pattern plays out again, and I'm not saying patterns always play out, but let's say it does, that next week is really, really, really rough for tech stocks. Let's measure out what 1 week will look like. It would be something like over here. So if you see yourself do this, if you see Tesla find any buying and the buying gets to the bottom side of the gap and it rejects off of it, I think even just being at the gap could be a comfortable entry to hedge against a really sharp downwards movement. Now, maybe we don't even make it a week because of FOMC and tech earnings on Tuesday, but let's say it looks something like this, not even making to the gap, and then I wouldn't say gap down because a sell-off would happen on Wednesday afternoon. If there's a sell-off, it'd look like this. And then eventually, after consolidating above the gap, it should kind of just disappear through it, or even a gap down if it times itself with a close and an open, and it just should look something like that. Now, what could make it not do that? Well, it's only going to be after Tuesday, I think. So Tuesday afternoon, when Microsoft Google report and there's a good response to, let's say, an AI story, and they found a way to monetize AI, which is the only important thing about AI. I mean, you could see Microsoft being such a big weight and Google being such a big weight for it to carry the NASDAQ up. So having a red NASDAQ on Monday could be beneficial for an entry for going long. So it would be something like by Wednesday morning, it should sit here at the bottom side of the gap and stay flat during the course of the Federal Reserve meeting. And then the press conference will determine if it comes down or is it able to at least break back up to the bottom side of the gap at 291. This happening in 1 week, I think it'd be very unlikely in my mind for it to retest the high. I don't think it would ever get to that point. I foresee a further consolidation until a good reason, a good story not to buy the stock, but to sell the stock. And that would be either Wednesday afternoon or Friday morning for the inflation report. So if you see Tesla green on Monday, could be an opportunity to hedge even further. If you see green Tesla on Wednesday, it wouldn't hurt to consider hedging even further, just to get through try to get through the week. Now, I wanted to show you kind of how the Nasdaq rebalance is really happening. So if you kind of want to get a pair trade, where if you feel that Tesla is not going to be, especially the trade for you at this moment in time, because of maybe the sentiment or the rebalancing or the or tech earnings that are coming up that can really affect Tesla. The way that the Nasdaq is rebalancing has shown that there is a path to some upside for certain names. Now I'm going to switch over to QQQ, which represents an ETF that represents the Nasdaq, and you can see the QQQ has kind of sold off over the last 2 days, along with Netflix and Tesla. So you can see how the weighting of Tesla and Netflix, just two stocks, can really drag down the Nasdaq ETF. So it's not surprising that they want to rebalance, because they maybe want a more accurate representation of the different sectors that they're offering to their clients. And we're going to kind of go through some of those, and also some tech names that are in the tech sector like Tesla and Netflix, who aren't experiencing the same drops like those two names are, and names like Microsoft and Meta. So let's look at Starbucks. And as you can see, when tech was selling off, Starbucks was actually remaining flat and also just up. And Starbucks, of course, is a company that sells coffee. How about Mondelez, a company that they make food more like snacks or desserts. And when you can see it, just like Starbucks, it's diverging from the rest of the Nasdaq, and it's actually going up instead. How about Cisco? Cisco is a tech stock, kind of like a tech stock, old school tech, but in the Nasdaq still, Nasdaq 100. And as you can see, at the same time that the bigger tech names were being sold off, even Cisco was able to stay more in line with the other non-tech names. Now let's look at Microsoft, which is a very large cap, big tech name, and you can see at the same time that those other names were being bought up, Microsoft was being sold off. And this is, of course, because maybe the rebalancing, or being really sympathetic with the moves of Tesla and Netflix. Here's another kind of old school tech name, semiconductor, Intel. Intel has actually been able to outperform the QQQ, which is really awkward because, number one, Intel is a very uncompetitive name in the semiconductor market. They don't have any AI chips. They're incredibly unprofitable, very much so in debt. They have very negative sentiment from traders, but has been able to outperform and even outperform Microsoft. Now let's look at our beloved Tesla to see the underperformance of Tesla. So Tesla was able to kind of maintain more of an inline performance with the QQQ until earnings, and it sold off very much so. But if you're seeing Tesla being sold off, there are things that are being purchased, things that are being bought up. So I know it from the macro perspective, from the bigger perspective, this is actually not necessarily bearish. The rebalancing of the Nasdaq, sure, it might cause short-term pain to tech stocks in the top 5 to 7 weightings of that particular index. But number one, the Nasdaq is not as big as the S&P 500. Number two, there are names that are going up. The Dow has been up for 10 days, 9 days in a row maybe. So there are names that are being bought up, and we talked about some of those sectors yesterday. The health, XLV sector, or the finance and XLF type of sector, they're being purchased. Utilities and energy are able to maintain or even outperform the S&P 500. So I would say that an overall gloomy look on the market is not what I'm trying to convey. I would say that to be in Tesla very heavily is very painful for now, and I think you won't have much relief for some days. And that relief can be very, very shortly lived because you need to convince yourself that there's some type of story that will allow Tesla to move in a direction that would be up. And looking back at Tesla's chart, I'm going to go back to the daily. Let's look at the chart. Tesla moves in chunks. It's like, you know, playing football and throwing the ball. This is on a, the running game would be a consolidation for months until there's severe enough news to move it in a direction. And otherwise, you're just treading water. Like you really have to understand that if you're wanting to day trade, maybe Tesla might not be where you want to put your entire focus on. There could be other sectors that are just easier to play, other names that are easier to play than Tesla right now. But it wouldn't hurt. Like, you know, Tesla has sold off for 2 days now. It is down, you know, 11.5%, 12% by Monday probably. That if it wouldn't be that expensive to take a cheap shot at going along. But know that the consolidation is going to break in a way that might not be that easy to take. So I would say if you're holding a lot of shares of Tesla, then it means you're already long Tesla. And if you want to day trade Tesla and be long Tesla, you're exposing yourself to a leverage double 200% long on Tesla, right? So just with caution and a very small size and proportion to your portfolio, you could maybe go long if you want, but it seems like if you're already long with shares, you want to day trade down to the downside to hedge against potential valued losses of Tesla. So it's all about having the story to break out of a range. We don't have one. Now, we talk about tech earnings, we talk about FOMC meeting, maybe a dovish press conference speech, presentation, whatever they call it. There could be a very low inflation reading next Friday. I would caution against being really hopeful for inflation. The comp for July is not as easy as a comp last year for June. So the June over June comparison, inflation reading was incredibly high. The July might not be as easy to beat, but definitely in August would be problematic. I think the August would have a very tough comp. So July might be a little bit more difficult to show a beat on core PCE especially. But August would be a tough one, a very tough one. And not to mention, August is really low volume. So if we're approaching the end of July, going into August and September are some of the worst months in performance. And sometimes the start of a lot of volatility because you have low volume. And so when a little bit of news comes out, moves become very explosive because our volume is so compressed right now that even the slightest bad news is going to send the VIX screaming to like 20 within 2 days, most likely. So I'm not saying to buy VIX. I would say the VIX is very cheap compared to what you're used to if you're day trading in 2022. The VIX is incredibly cheap. I understand that's because of the 0 days to expiration option availability is definitely increased. But right now, I'd be very, very cautious. And if you're going long on Tesla, just understand that like the move might not be substantial. It might not be like a 10% move to 310 or something like that. But if you get a good move intraday, I would say, take a win on your longs and be prepared to really hedge against very sharp declines in the prices of the stock. We didn't make a new high on a longer time frame. We didn't close effectively above our downward trend line. And we sold off for 2 days because no one is interested in buying Tesla. If you look at the volume of Tesla, you can tell there's big volume coming in, even compared to just, a couple days ago. There is a lot of volume, but all this volume is selling. There's very little interest in buying, as you can see from the indicators. They are going down. And there is more room for them to go down. If you think there's some type of mean reversion or some type of, bottoming out on the RSIs, there is still further down to go. Now, on a bigger time frame, if you're a really big time frame and you're looking at a monthly, yeah, I mean, as an investor, I don't think you really care about the intraday movements, and you could tell yourself, look, the MACD is going to cross over, and we can have some more upside. But for the next couple days, I would just be very, very cautious, and it wouldn't hurt to think about selling calls, holding puts on a very short-term basis. But that's the stuff that I'm doing. I can't recommend anything to you, of course, as it's not financial advice. But just be very, very careful out there. And thanks so much for listening, guys, and have a good weekend.